Everybody, and welcome back. This is problem 11-9, impairment. So Roland Company uses special strapping equipment in its packaging business. The equipment was purchased in January 2019 for $10 million. Had an estimated useful life of 8 years and no salvage value. And December 31st, new technology, basically the net cash flows and the fair value. Okay. So right over here, so they use straight line. So when we look at this particular question, so, and this kind of goes back to what we were doing over here. And so if I come back over here to problem 11-9, so we've got the future cash flows. The future cash flows for this are 6.3 million. And so what I first need to do is I need to compare this for future cash flows to the net book value. So if the cost was 10 million, no salvage value, 8 years, I would be taking 1.25 million of depreciation expense each year. So my equipment has a cost over here of 10 million. My accumulated depreciation, because I'm using straight line, it's going to be 1.25 million for 2019 and then 1.25 million for 2020. So my total accumulated depreciation on the equipment is going to be 2.5 million. So my net book value so my acquisition cost is 10 million. My accumulated depreciation is 2.5. So my net book value is going to be 7.5 million. And this tells us we need to impair the asset. When it comes to impairment, what I then have to go through and do is I then have to say, controller, we're going to be continuing to use this. So what I then need to do is that net cash flows are 6, the fair value is 5.6 million. So my impairment loss is going to be the net book value less the, whatchamacallit, less the fair value. So my impairment loss is going to be 1.9 million. Okay. All right. So prepare the journal entry to record the impairment. So I'm going to have loss on impairment on 12/31/20 of 1.9. I credit accumulated depreciation for 1.9. So there you go. So my new ending accumulated depreciation balance is going to be 4.4 million. When I take my pre-impairment, post-impairment, acquisition cost has not changed. My new ending balance is 5.6, which needs to equal the fair value. Okay, so that's what I would do for letter A. Prepare any journal entries for the equipment at December 31st, 2021. The fair value of the equipment at December 31st is estimated to be 5.9 million. Now, if I'm using this for my operations, I don't write up the value. So instead, what I'm going to go through and do is I'm going to go ahead and depreciate it. So, and basically I'm going to use it with the new information. It's going to be 4 years. So over here, I'm going to have 10 million. So my cost of the equipment is 10 million less the total amount of accumulated depreciation. So this is going to be my new depreciable base, which here is going to be 5.6 million. So if I'm going to be using this again, so it's going to be acquisition cost, or basically here my new depreciable base minus the salvage value, which is still going to be 0, divided by my estimated useful life. So this is going to be 5.6 million divided by 4, or 1.4 million. Okay. All right, so that's how I'm going to go through and record this over here. So the journal entry doesn't matter about what happened with the value of the assets. Okay, now this is where we get to fun stuff. Repeat the requirements for A and B, assuming Roland intends to dispose of the equipment that had not, but it had not been disposed of as of December 31st, 2021. Okay, so now we're going from used in business, and now we're just going to be going here to assets held for sale. So the loss on impairment is not going to change. The only thing that would be different is if I had an estimated, basically over here, if I had like an estimated recovery. And so, and then the other, so again, what I'm trying to say here is that if, in fact, so I have to, okay, so let's take a step back for a second. Now I'm holding this asset for sale. The asset is no longer property, plant, and equipment. It is going to become a current asset, and we're now going to call it assets held for sale. So repeat the requirements, assuming they're going to dispose of the equipment. So it's no longer property, plant, and equipment. We're not using it anymore in our operations. So in 2020, I still have to go through the same process. I'm still going to go here and say, all right, I'm debiting equipment. And then over here for my accumulated depreciation on that equipment, this over here isn't changing. I'm still going to go through and record the impairment. If I had disposal costs, I would have to add this to the loss, but I don't have it in this situation. So assume that they intend to dispose of the equipment and it has not been disposed of. Now, the thing that will change though, is that if the value of the asset goes up, which it did, to 5.9 million, then what I can go through and do is say, okay, my carrying value, or basically my net book value, 12/31/20, is equipment less the accumulated depreciation is assets held for sale. Okay, so over here, equipment is at 10 million, accumulated depreciation is at 4.4, so I'm at 5.6. Now, my carrying value, which is really the same thing as saying the net book value as of 12/31/21, I'm allowed to recover from my impairment, because if I'm holding it for sale and it's now worth 5.9 million, what I can do here is I can debit accumulated depreciation for 300,000. And this is going to be the difference between 5.9 million and 5.6 million. Okay, and then over here, I'm going to credit recovery of loss on impairment. Now, what's really important here is that we can recover up to the 1.9 million, but we cannot go beyond that. So over here, now the other thing I also want you to recognize too is that we don't take depreciation, right? In 2021, over here on 12/31/21, in this situation, because we continue to use the asset, I'm going over here to record. And down here, I do not record that's what the real big difference is because I can recover this against my loss, whereas I can't do it up here, but I cannot take any more depreciation expense. So what you're going to see here is that the 12/31/21 recovery, and this here is going to be 300,000. My new carrying value or my new balance of my depreciation is going to be here. So my new carrying value, my assets held for sale, is going to be this new fair value right over here. So hopefully you enjoyed that as much as I did. I know I did. Anyways, thank you for joining me here today, wherever you might be. And I look forward to seeing you on the next accounting video. Exciting. See you soon.